Good afternoon, and thank you very much for joining us today. Today, we will do a report back that we would like to start doing monthly. And today's focus will be predominantly on the investment strategy of the Sygnia Umbrella Retirement Fund. And then together with that, I will cover performance as well as some of the changes that we have made to the portfolios in response to some of the big events that we're seeing in the local and global economies. So as a start, I just want to remind you, and for those of you that aren't aware, but with effect from 1 March 2019, all retirement funds had to put in place a default investment strategy. Now, this default investment strategy is for members that do not want to make an investment choice as they enter a scheme. And for that reason, the fund will then have a default in place that takes care of member needs. Now, the ultimate goal of a retirement fund is to be able to provide members with a healthy retirement. You would want to be able to earn a very good pension at retirement. And in order to do that, members have to save as much as possible during their working life in order to have enough of a savings at retirement to be able to convert that lump sum into a monthly pension. And in order to maximize your retirement savings, we do have to earn inflation-beating returns over the long term. How we earn inflation-beating returns in your portfolios over the longer term is we have to invest in some riskier asset classes and a good mix of various asset classes, including equities, bonds, money market instruments, as well as some investments outside of South Africa. I will cover the mix of the investments in the asset classes a little bit later on. So what is the default investment strategy of the Sygnia Umbrella Retirement Fund? So members will follow a life stage model. So the trustees of the retirement fund have chosen a life stage model as the default investment strategy. And then each employer then chooses one of 3 life stage model philosophies. We do appreciate that the life stage model will work for the majority of members, but there are some members that may have individual circumstances and their own individual preferences, and for that reason, member investment choice is available. So at any stage, a member can opt out of the life stage model and invest into one of the 18 portfolios that we provide as member investment choice. Members are also able to switch their investments at any time, and the fund will not charge them any additional fees for switching. So what is this default investment strategy? So as I mentioned to you, the default investment strategy is a life stage model. Now, a life stage model is designed in such a way that younger members have higher exposure to the riskier asset classes, so your equities and your older members. So as you get closer and closer to retirement, you start having less of the riskier asset classes and higher investments into your safer asset classes, such as your bonds and your cash. So how it works in practice is your employer would set a normal retirement age. So that normal retirement age could be 60, 62, 63, 65, and up until 6 years before your normal retirement age, the model will default members into a portfolio that has about 70% invested in equities. And as you get older, so from 6 years before retirement, right up until retirement, as you get closer and closer to retirement, we automatically, and I say we, in our administration systems, we have everybody's date of birth, and we're able to switch members into a more and more conservative portfolio as you get closer to retirement. And that's depicted at the top of the slide. Now, I mentioned a little bit earlier on that there are 3 different life stage models that your employer could choose. So the employer can choose between a fully passive life stage model, so it's the low cost version, you could choose a passive and active mix, as well as our synergy range, which is a balanced portfolio. Now, to explain the philosophies of these three strategies, I thought it might be best to show you a graphical representation. So essentially, as I mentioned, the employer will choose between the skeleton, signature, and synergy range. And the differences really are that the skeleton and the signature range are what we call specialist portfolios, whereas the synergy range follows a balanced type of mandate. So the difference really is in the specialist approach, so that's in the skeleton and the signature ranges, the asset allocation, so the mix between the equities, the bonds, and the cash is controlled by the investment team at Sygnia. So in these two instances, the portfolio management team, depending on the market environment and the long-term goals of these portfolios, will come up with a mix, and they'll say we feel that about 70% needs to be invested in equities, a smaller portion in bonds, a smaller portion in cash. Once that asset allocation has been decided on, the team then looks at what is the best way to implement. So which managers or which passive strategies are we going to use to implement on our decisions. And that's why I've depicted it here on the left-hand side. So once we've decided that 70% needs to be in equities, in the skeleton range, for example, it will be done with indices. In the signature range, there will be a mix between active managers and some passive building blocks. And then the synergy range, as I mentioned, is what we call an active balance type of portfolio. So what we do on the local portion, so on the 70% that's invested inside of South Africa, we have given a portion to each manager. So we then outsource it and we say, manager one, you can have a slice of this portfolio, and depending on your views, how you view the world and the current market environment, that manager can then decide on the mix between equities, bonds, cash, and property. The offshore portion of all three of these ranges is the same, and it's managed by Sygnia Asset Management. From a risk and return perspective, so investment theory tells us that the higher the risk of a portfolio, then the higher the return. So what is risk? Risk is really the risk that you may lose some capital. So for example, if you invest in a share is riskier than investing in cash. But investors are rewarded for taking on that higher risk. And that is why theoretically, the younger you are, the longer members are able to take on this investment risk, so they can be invested in riskier asset classes in order for these asset classes to be able to provide them with these inflation-beating returns over the long term. So all of our portfolios, whether it's the signature, skeleton, or the synergy range, they have a similar asset allocation. As I mentioned, we control the asset allocation of the signature and skeleton range, and the younger you are, the higher the risk, but the higher the return of the portfolio. And then for those members that are closer to retirement, they take on less risk, but the expected return of those portfolios is also lower. So the reason why we want older members to take on less risk is we wouldn't want somebody to be heavily invested in riskier asset classes, and then the markets get shaken up. And a good example is what we've seen in February and March, and then a person would lose some of their investment value due to the volatility on the markets, and then would have to retire with slightly less capital. So then we'll jump into the investment performance. So how have these funds performed? So over the long term, what's interesting to see and what's important for members as well as management committees and consultants to understand is that because we are investing in the market, that the returns are not smooth. So you can see on this graphical representation that there is a definite upward trajectory, which means that the money is growing over time, but it's not growing by a smooth line. There's definitely volatility, and this volatility is when prices go up and down. So there's certain days where markets, go down. There's days where markets go up. And what's really interesting and quite obvious to see on this chart is if you look towards the end between January 2020 and May 2020, you see that representation of almost a V shape. And what we really saw is that the market sold off in February and March. We had some of our worst days in the local markets as well as the global markets, but then as quickly as it went down, some of the bounce back has been just as quick. So that recovery has come back up just as quickly. I will touch on what has driven some of that recovery a little bit later on, but we're not quite at the levels that our markets were at pre-pandemic. So what's the different lines here representing is the red line is the long-term performance of the signature range. The blue line is the synergy range. The different shade of blue just underneath that is then what the skeleton range has done over time. And then very importantly, the black line is the global large manager watch median. So the global large manager watch median is the median performance of the largest managers in South Africa that invest in these Regulation 28 mandates. So why that's important is that it's very well accepted as a benchmark for pension and provident fund portfolios. So you can see that, over time, all three of these ranges, these life stage ranges, have performed better than this very well accepted benchmark. And some of the managers that are in this global large manager watch median are your Allen Greys, your Coronations, and we've actually listed them at the bottom of this chart. So over time, these portfolios have done very, very well. So a little bit of a busier slide over here, but we're showing you how the various portfolios in the life stage ranges have performed over time, and this performance is to the end of May 2020. So what you'll notice if you look at the May column, that May was a positive month. Performance was just slightly shy of 1% for the signature range. But over the 1 year to 31 May, the portfolio, if we focus on the Signature 70 fund, has grown by 4%. Now, it's been a very tough market environment, as we're all aware. We find ourselves in a pandemic. We've seen countries going into lockdowns. Productivity and GDP growth has been projected to be much lower. So it's been a tough environment. So for us to be able to see these positive numbers, even though 4% is not the double-digit returns that we often hope for, we are very, very satisfied with how these portfolios have performed. What's quite interesting in this current market environment is over the long term, you would expect that your higher equity and property allocation. So for example, your 70 funds that have a higher allocation to the riskier asset classes would perform better. But what we're seeing, if we just focus on the 1 year numbers, is we're actually seeing that your more conservative portfolios have actually performed better. So why is that? So in this current market environment where investors are nervous, they take their money out of equities and they invest in bonds and cash, because those are the safe haven type of investments. And that's why the performance has been better in the lower equity allocation portfolios in this current market environment. And then, as I mentioned a little bit earlier on, there's also some members that may have opted into one of the member investment choice portfolios, and we're showing you the returns of these portfolios here. So you'll see that some of the managers, of course, have performed much better than others. So over the 1 year, we can see that the Ford Balanced Fund has done very well, returning 9%. There's the Allen Grey portfolio has struggled a little bit more, and they're almost flat for the year. Members can also invest into an Islamic balanced portfolio, so members that want to follow investments that follow the Sharia laws That's a portfolio for them. Another thing to point out over here is that the 91 Balance Fund, this is essentially Investec Asset Management that has rebranded and they now call themselves 91. And we can see that they've done 3.9% for the year. Okay. So what do these portfolios actually look like? So what are members actually invested in? So I've already mentioned this, but of course, younger members are invested in the 70 portfolio, so about 70% allocation to equities. And then as they get older, they'll slowly move from the 70 to the 60 to the 50 to the 40. So if we focus on let's say the more conservative portfolios, we can see that just before retirement, members will have about a 25% exposure to South African equities. They will have a large exposure to South African bonds, South African income, money market. So these are the safer type of instruments. So even if there is a market crash, they are not destroying the investment values. And then the global allocations are much lower as well. So as a person goes through their working life, they will have their mix of assets change as they get closer and closer to retirement. And as I mentioned to you, once the strategic asset allocation has been decided on, and for the skeleton and the signature portfolios, that's done in-house by the Sygnia investment team, the next step then is to say, well, then how do we implement these strategies? Once we've decided exactly what percentage should be invested in South African equities, what percentage should be invested in South African bonds, then who do we choose to actually implement those investment decisions? Now, the signature range is the range that has a mix between a passive and an active management. So if we look at the equity managers here on the left-hand side, you will see that we're using the Sygnia Swix tracker. So this is where we're accessing the market. So the shareholder weighted index is what we're tracking, but it's done via a passive tracker, and we do that in-house. But we also have we've blended that together with some active managers. So who are these active managers? It's ABAX Equity, it's 91, who I mentioned is Investec Asset Managers that have now rebranded. We've got a allocation to Coronation as well, and to some of our own building blocks there as well. Similarly, in the bond space, we have a blend between Coronation and Sygnia's passive bond fund. So again, it's that mixing of some active and some passive management. Now, the way that these managers, the active managers, have been chosen is they have been chosen to be very differentiated. So you wouldn't want, for example, in the equity space, you wouldn't want ABAX and 91 investment managers to have a similar philosophy. They've been chosen for the fact that they are different in their thinking. So some might be more value managers, some might be more growth momentum type of managers, and they've been chosen in such a way that we expect different managers to outperform in different market environments. In the skeleton range, this is the range that is fully passive. So in the skeleton range, it's our lowest cost range, and we're only using indices. So you'll see under the equity building block that it's simply the Sygnia Swix tracker. We haven't blended the Swix tracker with any active managers. So in this space, we're simply tracking the shareholder weighted index. And you'll see that across the various asset classes. In the bond space, it's only a passive building block. And the offshore, you can see that the various indices that we track, and we utilize some ETFs as well. And then the synergy range, as I explained a little bit earlier on, in this range, what we do is the portion that's in South Africa, we divided in between, we're dividing that portion between Allan Gray, Coronation, Investec, and Prudential. We've given them each a slice of the portfolio, but then we have given them the full mandate to decide in the mix. So Allan Gray, for example, may view the current market environment differently to Coronation, and they may have a very different equity and bond mix to what Coronation does. The offshore side, as I mentioned, is exactly the same across all ranges. So in the Synergy 70 fund, for example, you'll see that the largest allocation is actually to the Prudential Balance portfolio at just under 19%, followed by Coronation, and both Investec and Allan Gray have 16.9% of the portfolio. So with that 16.9%, they then decide what mix of the various asset classes in South Africa they want to invest in. So they're able to rotate in and out of these asset classes as long as they stick to the Regulation 28 guidelines. So Regulation 28, just as a reminder, is the piece of legislation that tells us how we can and can't invest pension fund money. So there's certain limits, such as you can't have more than 75% of the portfolio in equities, you can't invest more than 30% offshore, and these limits have been put in place in order to make sure that members' monies are invested in a well-diversified portfolio. You wouldn't want to invest everything with one stock, for example. It would be too risky, or just in one asset class, it would also be too risky. So that regulation has been put in place essentially to protect members. So what's also important is to compare how these portfolios have done against our peers. So who are the peers in this space? Well, it wouldn't be fair to compare a portfolio that's predominantly invested in bonds and cash with a portfolio that's heavily invested in equities and properties, for example. So Alexander Forbes does a survey, so it's important to note that the survey is independent and we haven't prepared these numbers, we've simply submitted performance. So all the managers that want to participate in these surveys, what they do on a monthly basis is they submit their data to Alexander Forbes, and Alexander Forbes then independently prepares these surveys. So on this slide, we have the low equity multi-manager survey. So all of these portfolios have a roughly 40% allocation to equities. So these are the more conservative portfolios. These portfolios are where members can expect to be invested just before retirement, or member choice portfolios, even if a young member wanted to opt out and invest into one of these portfolios. And now you'll see that our skeleton and signature portfolios have been the top performers in their categories. Over the 1 year, the skeleton 40 has been a top performer over 3 years, and you'll see that all three of our portfolios are just basically 1 basis point behind the top performer over the 5 years. What's interesting to note as well is that the longer the track record, the less peers we have in the space. Not everybody has a 7-year and a 10-year track record. That's why if you look at the 10-year numbers over here, you'll see our portfolios have been the top performers over 10 years in this low equity multi-manager category. But there's also less peers in the space. The way to read these numbers as well is these numbers are annualized. So what annualized means, if, for example, we look at the Signature 40 fund, over 10 years, that return is 11.1%. So a member that has been invested in this portfolio for the last 10 years to 31 May 2020, would have received a return of 11.1% per year for the last 10 years. So these portfolios have done really, really well in both absolute and relative terms when compared to their peers. So if we then look at the slightly more allocation to equity portfolios, so the skeleton, signature and synergy 50 funds, so these funds have about 50% of the allocation invested in equities. And again, they compared against very similar portfolios in terms of allocation to risky asset classes. So again, top performance over 1, 3, and 5 years, as well as 7 and 10 years. So very good performance and performance that has done very, very well against peers. Similarly, for the 60 funds, again, the peers in these tables have very similar allocation to equities, and the signature, skeleton and synergy funds are top of the ranking tables over 1, 3, 5, 7 and 10 years. And then the portfolios to really focus on. So why do I say we need to focus mostly on these portfolios is that we find that most members do not exercise their member investment choice. So they will follow the default that has been set by the trustees of the Sygnia Umbrella Retirement Fund, and then the strategy that's been chosen by the employer. So what I'm saying is that most members will be invested in the life stage model, and we find that there's very few members that actually exercise their ability to have member investment choice. That's of course a good thing because the models have been designed to look after members' needs over the long term. So if a member is happy to be invested in the life stage model, then for the majority of their working life, they will be invested in the 70 funds. So a member joins a fund in their mid-20s and they will retire, let's say, in their early 60s. So right up until 6 years before retirement, if they're following the life stage model, they will spend the majority of their working life in these 70 portfolios. So how have these portfolios done to the end of May? We can see that over the 1 year, top performance from the signature and skeleton funds. Over the 3 years, all three of the portfolios are top of the ranking tables. Over 5 years as well, right up there with the best performance. And then over 7 years and 10 years. And really important to look at the long-term track record in these tables, because as I said, members will be spending a majority of their working lives in these portfolios. So again, over 10 years, had somebody been invested in the Signature 70 fund, they would have received 11.9% per year for the last 10 years. What's interesting to also look at is to compare these multi-manager type of portfolios against the single managers. So single managers typically have very strong views in terms of style. I mentioned that a little bit earlier on. Some managers, for example, Alan Gray, are what we call value managers. So Alan Gray, what a value manager is Alan Gray would like to buy stocks that are underpriced. So they wait for stocks to kind of fall in price, that try buy them at the bottom, but it often takes a very long time for those stock prices to go up again. But when they do, because they purchased at a much lower price than somebody else, they see a much higher return. Whereas other managers, for example, growthy momentum type of managers, they follow the trends. So for example, Naspers has been running over the last number of years, and they would be purchasing these hot topical type of stocks as well. Then those type of managers may purchase stocks that are already expensive. So because of the different styles that managers follow and their processes and philosophies that differentiate one from another, we never expect one manager to be the top performer, you know, every year on year across various market environments. There's certain market environments that favor value managers. There's certain market environments that favor growthy momentum type of managers. That's why if you look at these tables, for example, you'll see Ford is the top performer over 1 year. But look at where Ford is over the 5 years. They are 1, 2, 3, 4, 5, 6. They're the 7th ranked manager. So this says to my point that no single manager is the top performer across all periods. But interesting to see how our portfolios stack up, especially over the longer term. So over 5 years, the Synergy 70 fund and the Signature and skeleton funds have outperformed a lot of the single managers, and again over the longer term, over 7 and 10 years, where it really matters over the longer term, these portfolios have done really well against the single managers. So lastly, just on performance, before I get into some of the markets and economics or what has been driving these returns that I've showed you, just to explain this chart on performance is what we call this is a risk and return scatter plot. So as I mentioned to you a little bit earlier on, the more risk that is taken in a portfolio, theoretically, the higher the return will be over the longer term. So what you wouldn't want is you wouldn't want your manager your asset manager of your portfolios to take on a lot of risk but not actually deliver on that return. So the way to read this chart, you'll see on the horizontal axis is we have depicted the risk. So, you know, is the portfolio taking 5% risk, 6% risk, 7, 8, 9, etc. So for each level of risk, you want the highest performing portfolio. So if I use the Signature 70 fund as an example, you'll see that this fund has taken on about 9% of risk, but they've also delivered just over 9% of return. So the way to read this is anybody that's underneath the Signature 70 portfolio has taken on the same amount of risk. So for example, looking at the AF Investments Performer portfolio, or this Momentum Flexible 6, or the AF Investments High Equity, all of these portfolios have also taken on about 9% of risk. But then if you look at the vertical axis, you can see that they've taken on the same amount of risk, but delivered less return. So when you look at this chart, essentially for every level of risk, you want the top performing portfolio. So again, from a risk and return perspective, we're very happy with how all of these life stage portfolios have performed against the peers. So now that we've seen the numbers, we've seen both the returns of the various portfolios, and we have seen how they stack up against peers, let's look at what has been driving the markets. So I'm sure there's no need for me to tell you that we find ourselves in a global pandemic. We find ourselves in this new world where everybody is working from home. And this really has been the biggest driver of the returns that we're seeing in the markets. So on the 11th of March this year, the World Health Organization declared this current pandemic as a pandemic. So what then followed shortly after that, and some countries even before that, is we saw lockdowns all across the globe. Now, these lockdowns, of course, affect productivity. You know, factories aren't producing as much as they used to. People are now staying at home. They're also not spending as much. And it creates an environment where we can expect GDP to fall. And we have seen that, and what we're showing you on the right-hand side is that what we've seen in 2020 is the deepest GDP fall that we have seen in the last number of years. Now, when we first became aware of this pandemic, and a lot of the literature written by both global, local economists and analysts, a lot of those comparisons were done, you know, what we're currently experiencing was being compared to 2008. And, you know, we soon realized that it's very different to 2008. In 2008, we found ourselves in a global financial crisis. And what we're seeing now is essentially a healthcare crisis. And what we have seen is that both the fall in the markets and the fall in GDP that's expected is much deeper than 2008. And if you look at the chart on the right-hand side, you can actually see that it's closer to World War II and Great Depression levels. So yes, it is scary, but on the more positive side is that we have seen a lot of support from governments, which I'll touch on a little bit as well. So as we saw a little bit earlier on when we went through the portfolios, we saw the performance of the portfolios, but we also saw the mix of asset classes that the portfolios are invested in. So of course, the portfolios invest in equities, they invest offshore, they invest in the bond market, and the performance can only be as good as the performance of the markets of the various asset classes. So what I'm showing you over here is how the broad asset classes have performed, and what we're showing you is the year-to-date performance as well as some of the bounce back that we have seen since April. So March as well as February were bad months. We found that most of the world was under lockdown, but in April we started to see, both due to the support provided by governments, but also due to the fact that some countries started relaxing lockdowns, some curves started flattening, and the outlook became more positive. We have seen a rebound in some of the asset classes. So if we look at the South African property index, for example, this is an asset class that has been really hurt, not just by the pandemic, but even before the pandemic. We have seen that this asset class has had a bounce back, though, of about 6% in April. So this bounce back is predominantly due to the fact that interest rates have been lowered. So when interest rates are lowered, we find that property tends to, perform positively. People can now afford their debt service costs much easier because the interest rate is lower. Oil has been one of the hardest hit over during this time, and to simply put it, it really has to do with supply and demand. So when we saw, most of the world going into lockdowns and countries closing their borders, planes weren't flying, people aren't traveling, they're not doing the business trips anymore. And that was one of the major drivers of why the oil price went as low as it did. And it's simply that there was an oversupply of oil. So these oil producing countries weren't able to agree on reducing supply in time, and that's why the price of oil kept going lower and lower and lower. We have seen a bounce back. That's really due to the fact that these oil producing countries have agreed to slow down supply, but we also have seen that there has been a pickup on activity, as I mentioned, especially in the Northern Hemisphere, as countries have started to come out of lockdowns. What you'll see is that emerging markets have done slightly worse than the MSCI World. So the MSCI Emerging Markets is the third from the top, and then just two below that, we see the MSCI World. Now, typically, whenever we find ourselves as when the globe actually finds itself in such an environment, we can, even in 2008 when there was a financial crisis, and now that we find ourselves in this healthcare crisis, what we see is that investors do tend to invest more, firstly in safer asset classes, but then if they have to choose between the emerging world and the developed world is seen as much safer. So they see it as safer to invest in companies in the United States, for example, than they would in South Africa, in India, in China. So emerging markets tend to hurt a little bit more in these types of market environments, and that's why you can see that the returns have been lower and the drawdowns in emerging markets have been bigger. So if we want to focus on some of the things that are to the right of the line, so everything to the right of the line has given you a positive return, and we'll see that the exchange rate is the second from the bottom. So what I'm showing you over here is the Rand dollar exchange rate. So year to date, the Rand has weakened. Why is this on the positive side? Well, when the Rand weakens and you invest in US dollars, when you convert that US dollar return to rands, it adds a positive rand return to your portfolio. And for that reason, the Barclays Global Bond Index has also would have added positive returns. So we're not investing in bonds, but this is really just due to the exchange rate. And we also, what I'm showing you third from the bottom, is the MSCI World in Rand terms. So you can see it in dollar terms, it was negative, but in Rand terms, it has actually added positively to your portfolio. So I mentioned that markets have bounced back due to the support that has been provided by governments. Now, what I mean by support is the support is twofold. What can countries do to support companies, their people in such unprecedented times? Well, governments really have two levers. The first is their monetary policy, and the second is their fiscal policy. So on the monetary policy side, what have governments done? So from a monetary policy perspective, governments can cut interest rates. By cutting interest rates, they're actually creating some liquidity in the markets. So even if we have to look at ourselves as individuals, if I'm paying off a house and I'm paying off a car, and all of those debt payments are linked to an interest rate, suddenly now the interest rate is 3% lower than it was this time last year. Now suddenly my car costs less, my bond costs less. If I have any other debt payments that cost less, I might have an extra couple of hundred or couple of thousand rands in my pocket at the end of the month, and hopefully I will then go and spend that or save that. But if you spend it, you spend it in the economy. By spending it in the economy, I'm supporting the shop owners, I'm supporting employment, and that's the knock-on effects. In addition to being able to lower interest rates, because let's be aware of the fact that not everybody can lower interest rates. So global interest rates are much lower than ours. So the United States, for example, was only able to cut by 25 basis points. So if global interest rates are low, say, for example, some countries are sitting at a 1% interest rate or 0.5% interest rates, they cannot lower interest rates by 3% like we have. So what other levers do those governments have? Well, they can also do bond purchases. So they can purchase some of the bonds that are in the market, again, creating liquidity. And then we've seen countries such as Japan that are not only purchasing bonds, but they're also purchasing a lot of the ETFs in the markets as well. So if you look at the little chart that we have on the left-hand side, you'll see that the levels of liquidity that we're seeing now are really at levels never seen before. So the support from a monetary policy perspective has been really a lot, and relative to previous times, even in 2008, these levels are much, much higher. And then on the right-hand side, we've just showed you some of the, economies, the very well-known bigger economies, and what they have done in terms of creating liquidity. And in South Africa, we cut interest rates, and the SARB has been purchasing these government bonds. So then the second lever is, if there's only so much you can do from a monetary policy perspective, you can cut interest rates, you can purchase some of the bonds in the market, but what else can governments do? Well, they can spend. So from a fiscal policy perspective, that's the spending of the government. And what we have seen across the board is just massive, massive, massive packages. And these packages, just to put them into perspective, we often look at the sum of money as a percentage of GDP. Because sometimes, just saying $100 billion, the number is all relative really to the GDP spend. So you'll see on the bottom right-hand side of this slide, the South African 500 billion stimulus package equates to about 10% of GDP. So it really is a large stimulus package. It's the largest of our emerging market peers. And then if you want to compare it to some of the other countries, you'll see that Canada's, for example, is about 12% of their GDP. China's was much smaller, 3% of GDP. So various countries have done whatever they can, borrowing, readjusting the budget, just as we have. I mean, we heard Tito Mbowene's speech yesterday he delivered a speech in February, and now again, it's a readjustment. This pandemic has hit us. We have to react. So how will the money now be spent? So he spoke a lot about the new spend and where this 500 billion will be spent going forward. So again, between the monetary policy and the fiscal policies of various governments across the board, the support has been phenomenal. And this is why we have seen markets running. So with the fiscal policy, for example, what that spending is used on is, it depends from country to country, but in our country, for example, a lot of it is used for grants, some of it is used to assist businesses so they can stay afloat. It's gone into very well needed infrastructure for certain schools, for water sanitation. So there's various spending that can help countries in this current market environment. And just to focus more specifically on South Africa, not only do we find ourselves in a global pandemic, and we've experienced lockdown level 5, we've experienced lockdown level 4, we now find ourselves in lockdown level 3, but in amongst all of this, we also got downgraded by Moody's. Now, the Moody's downgrade has been something that we have been expecting as a country for quite a while. It's something that has been in the media for the last 2 years or so. It has been a hot topic, and eventually Moody's pulled the trigger on the 27th of March and we got downgraded. The biggest implication of the downgrade is that we are now a non-investment grade country. When you're a non-investment grade country, the rules of the World Government Bond Index say that only investment grade countries can be in that bond index. So the biggest implication was that we no longer form part of this World Government Bond Index, which means we're no longer going to get flows by various global investors, massive global sovereign funds that follow this index would have been just investing in South Africa just because we were part of that index. Now we're no longer part of it. And a lot of money had exited South Africa at the end of April when we were downgraded. On the positive side, though, we have seen, as I mentioned, 2-3 slides before this, we've seen massive interest rate cuts across the board. Now, because global interest rates are essentially sitting at 0, investors do look for yield. Now, when you're investing in bonds, the coupons and the returns that you have from those instruments are linked to the interest rate. So if interest rates are 0, then that's not a very attractive asset class. So what we have seen and what we will continue to see in the coming months is that we'll see global investors that are looking for yield will still find the South African market very attractive. In addition, it's not all bad news. This downgrade by Moody's, I already mentioned, we've been expecting it for a long time, but expecting it is one thing. Another thing is to have it fully priced in. And what we did see is that bond yields actually strengthened after the downgrade, and that proves to us that this event was fully priced into markets. Markets expected it. And we've actually seen that our bond markets have performed much better post this downgrade by Moody's. We've also seen that our terms of trade have improved. Our largest import is oil. Because the oil price has fallen, we've benefited there as well. From a growth perspective, we heard in Tito's speech yesterday that we can expect to see a contraction of about 7.2% this year. These numbers they have been revised, as well as the global growth contraction numbers. So having said all of that, so we've spoken about performance, we've looked at some of the major drivers of returns, and of course the biggest thing that all asset allocators are looking at is really the situation that we find ourselves in. So looking at all of that, so where are we investing the money that your members are investing into our portfolios? Where I've shown you the asset allocation, but what have we also done in response to some of these big events that we have been seeing in the markets? So firstly, from a risk management perspective, we've been very focused on the current pandemic, the various lockdowns across the board, and we're looking at various studies and data coming out of a lot of these global companies that have done studies. Now, if you look at the charts on the right-hand side, there's been various studies that show or they allude to the fact that there is not really a lot of evidence to show that there's a second wave. Especially when countries exit lockdowns. And the one a little bit lower down on the slide shows you the correlation between the mobility of people. So as you start exiting lockdowns, when people are starting to move around, how that correlates to higher infection rates. So what we can sort of conclude at this stage is that social distancing does appear to be effective. In the developed world, the response has really been to do a lot of testing, a lot of surveillance on people to try and trace contacts of those people that have been infected. So that has, it's been shown to work. Why I'm hesitant to say, very hard things on these studies is simply this hasn't been around for long enough. It's only been a couple of months, and all of these studies are done with relatively limited data. I mean, we're finding new things as we go along, but so far, these are some of the trends that we can see from some of the global studies. If there had to be a second wave, though, does that mean that there'll be a second lockdown? So these are the type of things that when we're investing money, we have to be very cognizant of, because of course, if there is lockdowns across the board globally and locally, we'll of course have to position the portfolios in such a way to harness the volatility that comes with that. So even before this pandemic, we positioned these portfolios for what we call Japanification. Now, why do we call it Japanification? Is because we're using Japan as a case study. So Japan already 3 decades ago was one of the first countries that entered into this low growth, high volatility environment. And it was really driven by the fact that they have an aging demographic. So you have more and more older people that are living on pensions, they're living on limited incomes, they're not really spending that much in the economy. And the country has skyrocketing debt, and debt hampers growth. Now we've seen that Europe is entering into that environment. And now with all this, monetary support, cutting interest rates, buying up of the bonds that are available in the markets, what we can expect, especially in the short to medium term, is really a low growth type of environment across the board. So we have positioned our portfolios for this low growth environment even before this pandemic, but we can expect this, especially now with the some of the monetary stimulus that I mentioned, we can expect this to be affecting more and more economies. So we have been positioned, and how do you position yourself for such an environment? Well, we've reduced our property exposure down to 0. The only properties that is in our portfolio is the property that's in the SWIX. So there's a little bit of property exposure in the shareholder weighted index, but it's not an active decision where we're saying that we want to specifically invest in property. We've also increased our exposure offshore. So as I mentioned to you, the regulations only allow us to invest 30% offshore, but we've taken that full 30% offshore. And we've also started to invest in income type of assets, which we've also slightly reduced now due to the lower interest rates, which I'll touch on as well. So from a tactical perspective, so from a strategic perspective, the strategic view is our long-term view. And the tactical is what we do more on a shorter term basis in response to what we see in the current market environment. So what we've done is we've reduced our exposure to South African equities. Now, I mentioned to you a little bit earlier on that emerging markets do tend to hurt a little bit more than the developed world. So we have reduced that exposure in favor of global assets. From a diversification perspective, we feel that that's the right mix for these portfolios. We remain overweight that global, so we're utilizing that full 30% that we can invest outside of South Africa. We continue to avoid global bonds. So I mentioned a little bit earlier that, the global bonds, your coupons are linked to interest rates, and we've seen that the developed world's interest rates are at, basically at 0. And for that reason, global bonds are not an attractive investment. So we don't invest in global bonds at all. And what we have done is we've actually upweighted our allocation to local bonds, to South African bonds. So now, especially with the interest rate cuts, it's less attractive to be invested in money market instruments. So when you invest in money market, I mean, even if you deposit money in a bank, you'll know that those savings and the return that you'll get on those savings if you just invest in money markets is linked to the current interest rates. The interest rate is now lower, so it's less attractive to be invested in those type of instruments, and that's why we favor global bonds at the expense of cash and income. And then lastly, what I want to cover is what we're doing from an ESG perspective. So what is ESG? E stands for environmental, S stands for social, and G stands for governance. Now, last year, there was a note that was issued, and it was it's Guidance Note 1 of 2019. So that guidance note basically stated that all pension and provident funds have a responsibility in the type of assets that they invest in. Now, all around South Africa, there's some, big pension funds, and even some of the smaller ones, small pension funds investing on behalf of their members. They have to be responsible as to where they actually invest the money, and ultimately what type of investments are they fueling with all of these contributions. So now in the investment policy statements of these funds, we have to, as investment consultants in those investment policy statements, we have to then state what the board of trustees of these retirement funds are doing from an environmental, social, and governance perspective to make sure that investing is done in a responsible manner. So in the summary, what we're doing from a Sygnia perspective is for all of our passive funds. Now, our passive funds, as you saw in both the skeleton and the signature ranges, for example, on the local equity side, we invest in the shareholder weighted index. Now, we ultimately investing in a lot of companies such as your Naspers, so every company that's part of that index. And previously, we never used to vote our proxies. So what voting your proxies is, if, for example, Naspers wanted to appoint a new board, or they had a new remuneration policy of their board, well, ultimately, all of us and the members of all of our funds are, we're actually holders of those shares, and as part owners of that company, we should have a say in the remuneration policy. We should have a say in, if there's a new board of directors. So that's what's voting your proxies is. As a shareholder, you have a right to vote yes or no to some of these proposals done by the big companies. So now, although we're passive holders, so we're not making an active decision to invest in Naspers, but just by virtue of the fact we're following that index, we are holders, big holders of Naspers as an example. We've now started to vote our proxies on behalf of yourselves as our clients. In the Sygnia credit portfolio, what we've done is we've incorporated ESG into the credit process. We also now have a Sygnia Impact Investing Fund that we're very excited about, which is the Oxford Sciences Innovation Fund, and I do have a slide after this to explain what that's all about. And then we also have a certain share class, the S class of our Sygnia Money Market Fund, where we don't earn any fees, and the fees that we would have earned on that portfolio are all donated to charity, and we also use some of those fees to donate to companies that fight corruption. So we support ALTA, so in a lot of these corruption fighting initiatives. But then you saw in some of our portfolios, for example, in the Synergy range as well as our Signature range, we also have some active managers that are making the decisions. So if we say, well, Alan Gray, you have a slice of this portfolio, then Alan Gray goes and buys your Naspers and your BHP bulletins. Are they being responsible with some of the shares that they purchase? So what we do with our active managers is, of course, we meet with them on a regular basis, and we question them on their ESG strategies. So when they meet with managers of those companies, do they ask the right questions? Are those companies doing the right thing when it comes to these environmental, social, and governance matters? So they do report to us, and these reports are available, and we can provide them to to any of our management committees or consultants. So the Sygnia Impact Investing Fund that I mentioned to you, we're very excited about. This fund is a portion of all the portfolios on the offshore side. There's a portion that's invested in this impact fund. And what it essentially is, it's really the meeting of scientists and business. So at Oxford universities, there's very, very bright individuals that may come up with new ideas with regards to new medicine, or it could be a new medical device. Once that idea has been approved internally and proven to work, then they'll apply for a patent on the technology or the new medication, the new vaccine, whatever that new idea is. Once that patent has been approved and registered, that's when business then comes in, and they assist with both funding and business expertise to take this now registered patent and this new idea and make it into a commercially viable business. So what you'll see on this chart is over time, there's been more and more companies that have spun out of this. And all of these companies are focused really on the health and biosciences. What's very exciting as well is that one of the companies that's sitting in this fund is one of the companies that's really close to, getting the vaccine for the COVID-19. So that's very exciting. Not to say that we expect some major windfall in terms of, return on that, because, the vaccine is most likely going to be provided, free of charge to the rest of the world. But this is really a testament to how brilliant the individuals, coming out of this Oxford Sciences Innovations are, and how really the meeting of science and business to take these into commercially viable businesses has been working. So we're very excited about this. For another reason is that it has been closed to new investment. So we find ourselves in a very lucky position to have been able to secure a slice of this fund. And it's now closed to all new investors. So if there's other institutions, both in South Africa and abroad, that wanted to invest in this fund, they're no longer able to do so. And what does then Sygnia own in terms of, so what's the ownership arrangement here, is that we own 25% of all past, present, and future patents. This investment is also, all of these companies are at the stage of they're not listed on exchanges, so it's seen as more of a private equity type of investment. And for that reason, from a performance perspective, private equity is very decorrelated, so it tends to behave in a different manner to your traditional listed asset classes. So again, from a diversification perspective, it really does really add that good diversification value to your portfolios. And then lastly, it's also denominated in pounds, because this is in the UK. So this is by no means a view on the pound from our side, but it's again just that extra level of diversification and a nice mix to your portfolios. On the local side, I mentioned that we do have ESG incorporated into the credit process, and we are actively engaging with industry on social green transition bonds. Approximately 6% of our core income portfolio is invested in green bonds. And we also support, for example, what we're showing you here as a case study is this TUHF. How this company works is that, finance is provided to local entrepreneurs, to women, to previously disadvantaged individuals. What they do with that funding is they clean up inner cities, refurbish buildings. It's a win-win scenario where they're able to provide lower cost housing to people that work in the cities. and also clean up the inner cities. And from a return perspective, these type of investments have proven to be very fruitful as well. So the exposure, for example, that we have in the credit portfolio to this TUHF is just shy of 3%. So that's all I have for you in terms of slides for today. So just to summarize what we've covered is we've covered performance, what has been driving the performance, what are some of the changes that we've made in response to the current market environment, and then I've touched on what we've done from an ESG perspective. The idea going forward is to hold these sessions monthly so we can provide you with fresh updates on what has been going on in the market, and then to focus each session on something important with regards to the Sygnia Umbrella Retirement Fund, but to focus on something different every time. This session focused on the current strategy, so I took you through the different ranges and the default regulations. In other sessions, we'll cover fees in a little bit more detail, and we can cover various different aspects that are important to the investments of your portfolio. So if you have any questions, you can type your questions in now. I can answer a few. Alternatively, we can also have a look at the questions and provide a very detailed Q&A after this. So the one question that I see over here, the question is, are the performances that are presented after fees or before fees? So the general standard across the industries, especially when you're showing performance relative to peers, is to have a gross fee performance. So the performance was before any fees are deducted. Would OSI be beneficial for individual investors? And if so, what are the fees and the minimum investments? So there's a lot of information available on the OSI fund that we can provide you with, and you can look at our website. I would say that yes, it is a beneficial investment for individuals for the same reasons that we find it very beneficial for our retirement portfolios. It is a decorrelated type of investment, and the fees are 1.8%. No other question seems to be coming through at the moment. So what we will do is, if there's further questions that come through after the session, we will, as I mentioned, prepare a Q&A or email it out to everybody, and you can have a look at some of the questions and answers that came through from other delegates. So I thank you for listening to me today, and hope to see you next month. Thank you very much.